If you're going into 2025 expecting another 20% return year, we've had two in a row, by the way. If you're expecting another 20% return year, I think there's a very high risk that you're going to be disappointed.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, welcoming you here at the end of another week, but at the beginning of another year with my good friend, the rejuvenated Lance Roberts. Lance, how you doing?
I'm good. I'm good. So, starting a brand new year here, 2 days in. So, we're now going to get into the January statistics, right? So goes the first 5 days, so goes the month. So all eyes will be really kind of focused on that right now.
Yeah. Okay. So a couple questions for you around that. One, did is this one of the 25% of the years where the Santa Claus rally didn't show up? We are on an up day, the day we're talking here, Lance, but S&P is still lower than it was heading into the Christmas holidays. How many days in the new year does it take for that axiom to usually kick in? Is the first 5 days of the year?
No, it's the first 2 days. So if the
First two
market,
days, okay.
yeah, so if the market can rally about 1.2%, so we're talking this morning, it's Friday. I know that people watching this now, it's Saturday, but so this morning on Friday the markets were up about 70 bips so far. But if we can get to about 1.2% by the end of the day on Friday, the Santa Claus will have been considered to be successful. So we'll have a slight positive bias, for the markets over the last 5 days and the first 2 days of January, which is the typical Santa Claus rally. Now, you've got to take that with a little bit of grain of salt because, again, so when you look at the Santa Claus rally, 24% of the time, it doesn't actually occur, right? So there's that 24.7% chance that you don't get a Santa Claus rally, and we may or may not get that as of the close of business today. But interestingly enough, so people say, well, if you don't get the Santa Claus rally, then that potentially bodes, poorly for the next year. So don't have Santa Claus doesn't visit Broad Wall, then potentially the market is, not so good in 2025. Then you have the first 5 days of January. So goes the first 5 days, so goes the month. So if that does well, the year does well, historically speaking, right? So you get decent returns. Now, in a year where you get, here's some interesting statistics, right? So in a year where you have a failed Santa Claus rally, a positive first 5 days and a positive month, the year is not so great. It's about 2% return historically. So it's an up year, but it's not a great up year. The problem with that is that you have to go back to 2024. The beginning of this past year, we did not have a Santa Claus rally. We failed the first 5 days. We had a positive month and a whopper year. So you got to be careful with these statistics. Again, these are based on averages and historical norms, but there's things that can happen that kind of debunk some of those sometimes. And 2024 was a good example where those old axioms really didn't hold up well. Now, again, 2025, it may be an entirely different story. We'll see. But, it's always, markets are going to focus on this initially, and then we'll figure it out as we go from here.
Okay. Yeah. I mean, all these things sell in May and go away. Santa Claus rally, so goes the first 5 days, so goes the year. They're adages, right? They're not universal rules. Okay. So you said in general, no Santa Claus rally, but good first 5 days. You have kind of a meh year, maybe even a little lower than meh, 2%. Obviously last year being an exception to that. Kind of on average, what happens if you have no Santa Claus rally and a negative first 5 days of the year?
And if you also have a negative January, historically you have a negative return for the year. So, again, on averages, but there's been times we've had that before and had a positive return. So, look, I think there's a lot of reasons as we move into 2025 to expect lower rates of return. We can talk about that later. But there's a whole lot of things that are out there that suggest that if you're going into 2025 expecting another 20% return year, we've had two in a row, by the way, if you're expecting another 20% return year, I think there's a very high risk that you're going to be disappointed. And if you get an 8 to 10% rate of return after two 20% years, you're probably going to feel disappointed also. But I think, there's a real possibility that we could see higher volatility this year, have a decent correction sometime midsummer, 10, 15, 20%, have a rally into the end of the year. And we look back over the course of the year and go, wow, that was a meh year. We were up, 8% for the year. And I think that's a reasonable expectation given kind of some of the market dynamics we've got. But again,
Okay.
that's just, kind of looking out. We could have another 20, 25% return year this year. I mean, it can happen. I mean, there's the drivers of the returns last year had nothing to do with anything other than liquidity. And we just had a ton of it.
Yeah. And on that, just to remind folks, the liquidity maestro, Michael Howell, who's going to be coming on this program in a couple of weeks, folks. So we're going to get an update from him. I monitor his work, and he still expects liquidity to increase in 2025. That being said, the rate of the increase is going to be slowing, and therefore he expects it to have much less of a supportive or lifting force on markets than it's had the past 2 years.
Yep.
All right, Lance, sorry, just to really dive into this. When you say the first 5 days of January, first 5 calendar days or first 5 trading days?
Trading days.
Trading days. Okay, yeah. So we still basically have 3 more trading days after this weekend to find out how this goes. So markets didn't have a great first trading day of January, and I'm just curious. Do you think that was influenced at all by the terror attacks here in the U.S.?
No.
Could there be some sort of artificial negativity on that first start date?
Well, yeah, I mean, look, I mean, when you have a headline event like that, I mean, there's always kind of a knee-jerk reaction. But, honestly, if you kind of looked at the selling pressure that we had yesterday, it was in Tesla for the most part, which is one of the biggest market cap drivers of the kind of the markets. And everybody was like, oh, it was down because they missed deliveries. And that's not really why it was down on the first day of January. It's because it had a huge gain last year. So if I'm a portfolio manager, I'm now overweight that position. This is really what we've seen over the last, 5-6 days in the market. We've seen a lot of selling pressure. And we talked about this earlier in the year, earlier in December, is that because of the returns we've had in the markets over the last year, if I'm a 60-40, 80-20, 70-30, whatever portfolio manager, I'm overweight stocks. So I've got to sell those stocks. So we saw a lot of tax loss selling going into the end of last year. So bonds were under selling pressure, taking the tax losses off those. Stocks that were really overweight in terms of positions, we saw pressure there. But if I'm a portfolio manager and I've got a big tax gain in something and I've already made my distributions, I'll wait until the first day of January to make that sell because now I don't have to pay taxes until next April.
Right.
So I get a whole year of not having to worry about taxes. So we saw a lot of selling pressure in some of those big cap names that have had very, very large returns. We saw a lot of the push in the mega cap stocks. That was a lot of that positioning. We talked about before that a lot of portfolio managers were underweight the mega caps. They need to get those weightings up by the end of the year. So we saw kind of a lot of that push. So sure, as is always the case, if you have something, like a tax or something like that, that will certainly trigger some of the selling, but the need to sell was already there. So, whether I sold, yesterday or today or next week, if I'm a portfolio manager, really doesn't matter. I still have the tax deferral until next April. But that event, right, it triggers kind of the algorithm to say, okay, take it, and they took it yesterday. So and then okay. I think, and today's why you're seeing Tesla up again, right? So now they're sold it. I've got the tax gain, so now I'm gonna weight it back up in my portfolio.
Okay, so I guess to that then, I mean, obviously we only have 2 days of the 5 days, and obviously that's still way too little to really make a market prediction. But you can almost say you shouldn't really worry about a bad first day of the year because to a certain extent, you're going to expect people that have a tax advantage move by waiting until the first day of the new year, as you mentioned, to sell them. So, don't freak out.
Yeah. Well, and again, you always have to remember that, as humans, we're always wanting to assign a rationale to something, right? Why was the market down this morning and up this afternoon? And or, what happened yesterday? So I try to go out and find a headline that kind of aligns with whatever my thought process is, oh, that's the reason it was down. In reality, with the way the markets are kind of really driven these days, it's mostly computer algorithms driving most of the trading. So, technical signals, support levels, positioning, sizing, all that stuff's just being algorithmically driven. So a lot of the stuff that happens from one day to the next really doesn't have anything to do with events. It just has more to do with kind of positioning within the markets and how these computer algorithms are just adjusting for that. And then you do get some selling pressure from individuals and from, portfolio managers, et cetera. But those are more kind of, driven by, again, back to position sizing, risk management, those type of things. Really doesn't, and again, an event when it occurs is usually just the reason for somebody to say, yeah, everybody was, we talked about how in December, everybody was on one side of the boat. And then eventually something would happen and we have to go to the other side of the boat. And that's what we've seen over the last few days. And so when something happens like that, we see the shift in the markets, we want to go assign a reason to it. But really, it's just the catalyst that got the sellers to go, I need to sell that. And they hang on as long as they can. Eventually, they'll sell and reduce their position risk. And that's really all we've seen here. It's been nothing major, nothing dramatic. It's been very orderly. And again, markets are now oversold enough. Breadth is oversold enough. Technicals are oversold on multiple levels. I think we're kind of set up here for a pretty decent rally, at least through the inauguration.
Okay. Well, let's get ready to pull up the S&P chart so you can kind of show us technically what that looks like. But before I get to all that, just a high-level question for you here, Lance. I'm just asking you to totally speculate here. Sure. And let's pray this does not happen, right? Get that right out in front. But I think the two attacks that happened, right over New Year's, have certainly caught the attention of Americans for all sorts of valid reasons. But this sense of like, whoa, wait a minute, sort of, these type of terror attacks are now coming to America, potentially coming to America more. We've seen them more elsewhere in the world. Is this the beginning of a wave, right? Or is this sort of a potential new era of domestic terrorist attacks here in America? Again, pray that's not the case. Hope it's not. Assume for a moment it is, Lance, like this is something that builds from here. Would you expect to see any sort of market implications for that?
Well, sure. I mean, if you start having, look, again, it also depends on the response. I know a lot of people probably listening to your channel may not have even been alive in 2001. It's so long ago now, but during the terrorist attacks, we shut the markets down for 4 days because we didn't know what the result was going to be after that, right? And what what was going to be the implications. So, the immediate knee-jerk reaction and I remember exactly, and I think anybody that lived through September 11th remembers exactly where they were that day. I can tell you exactly. Went on, exactly where I was. I was in my office. We were, working in the markets. And, as soon as we saw, kind of figured out, when the first plane hit the building, everybody's like, what an idiot. How do you fly into a building, right? What went wrong? And then you saw the second one, everybody goes, oh my gosh, now I know what's going on. And the markets immediately went into free fall. And the reason is that we had no idea what any of this meant. Was this just, we had no idea what was going on. It was just, we knew something bad had happened. And so the immediate reaction was, I need to get out of the markets. And we just sold off everything. And then the markets basically closed for the next 4 or 5 days as we kind of sorted these things out. If something like that happens again, I would certainly expect the markets to immediately, kind of sell off pretty sharply as, and we would probably be selling pretty aggressively as well, simply as a function of we don't know how this is going to happen. I mean, a good example of this was really more recent in 2020. In early January, we were reducing portfolio risk in our portfolios because we were writing articles about this is nuts. The market's just way too extended. Something's going to happen here. We've got this rumbling of this virus that's going on in China. And so we started reducing portfolio risk, but we had no idea that we were going to shut down the economy in March, right? And just close everything down. So we'll have, there'll be warning signs in the markets, but then some event like a major terrorist attack, and again, we certainly nothing that anybody wants, right? But if we do happen to have a repeat of a 9/11 type event, and there's certainly a lot of chatter about, terrorists that are potentially have immigrated inside the country, and there's terror cells here, et cetera. Something that if they are able to pull off something like that, I would certainly expect a very sharp knee-jerk reaction, from the markets, and then the response will be the most important. If it's just an attack, heaven forbid, and and then it's solved pretty quickly. We know who did it. The response is in place. I would expect the Federal Reserve to come in, and immediately stop, if we're still doing QT at that point, which I don't think we will be, but immediately stop QT, provide liquidity to markets, and assuming we don't shutter the markets, you probably see a fairly sharp rebound immediately after that.
All right, so again, this is a morbid exploration, and I feel apologize for folks for doing it, but it's worth spending a minute or two on. All right, so that all makes sense to me, Lance. And let's assume, again, let's hope for a moment we don't have another 9/11 type of thing. Let's hope we don't have anything going forward from here. But in what if instead of a major terrorist attack like a 9/11, it's more of like what happened in New Orleans? It just happens more frequently, right? Which is it's not as much of a loss of life, but it's just this progressive, sort of guerrilla, attacks that just persist throughout the year. Is that something that would weigh on markets? Or because you've said at times like, the market doesn't really care, who gets elected president, right? There are certain things the market cares about. There are certain things the market doesn't care about. Would a protracted kind of internal campaign of events like this eventually cause the market to care, or would the market eventually not care because it's just part of the soup now?
The markets would not care. So if you start having repeated attacks, and again, nothing anybody wants by any stretch of the imagination, but let's just assume we start having an attack once a week, right? Initially, and again, this is all hypothetical, right? Don't really.
I started this saying I'm just going to ask you to speculate. Yeah, exactly. No.
But just knowing how markets work after being in the markets for so long, what the markets would do is, if we're having an attack every week, the markets would analyze that pretty quickly, because the reason is what the market will look at is go, okay, we're having these attacks, but is it impacting earnings? And if you can create a correlation between the attacks, now here would be the example: you start having an attack once a week, and all of a sudden everybody's just starts staying inside, nobody's shopping. Nobody's ordering packages from Amazon because they don't want to pick up the packages on their box, because on their porch, because they don't know what's in the package, theoretically. Now, that would have an economic impact because you've had a contraction in spending. That would impact earnings, and then markets would start to decline, because then you'd have to start repricing markets for expected earnings. And this is one of my cases for a lower return year this year. Right now, the S&P's, Wall Street analysts are expecting $249 a share in earnings. Now, that's down $2 already since December. It was $251 in December. As of January the 1st, it's now down to $249. The long-term trending growth, logarithmic trend growth going back to 1950 is about 180.
Right.
So you're
just to remind folks, we walked through the charts of this last week. So yeah, right. Exactly.
So you're basically, $50, $60, $70 above the long-term average. So again, Wall Street is very optimistic on earnings this year. And one of the most fascinating things right now is that analysts are expecting 44% growth in earnings for small cap stocks. So I've been posting charts over the last couple of weeks on Twitter and X, and I posted one on Monday. I go, I still don't get it. How are you expecting 44% growth in small cap companies that are the most economically dependent, mind you, when they haven't been able to grow over the last 2 years, when you've had well above normal rates of economic activity? And economic growth is slowing, it's not increasing. So we're going to continue to have a contraction in the growth rate of GDP. And you're also saying at the same time that the growth rate of the companies that are generating massive amounts of cash flow and earnings, Apple, Tesla, Microsoft, et cetera, they're going to slow down, but somehow small caps are going to rise and all of a sudden just start producing massive profits. it may be the case, but I don't know how you make that case, right? But this is the expectations are so out of whack with how markets actually work over time that I think anything that introduces some risk to those earnings estimates causes the market to start to reprice, especially when we're talking about 37 times trailing earnings and about 20
Right.
times forward earnings. You've got pretty stretched valuations, and so anything that impacts those expectations for earnings, you're going to have a repricing of the market this year. And that's why I'm suggesting I think we see lower rates of return this year. It may be 8 to 10%, and that'll feel terrible and be like, man, what a crappy year, but that'll be normal.
Yeah, I kind of think of it as sort of like a Jenga market at this point in time. I think we talked about that, which is, when the Jenga tower gets
Yeah.
real tall, right? It takes a much smaller amount of force or disturbance to cause that thing to really start wobbling, right? And then when you
Right.
have valuation multiples that stretch, that's the analogy, right? Is these crazy price to sales and price to earnings ratios we've talked about. To your point, anything that just looks a little bit challenging to earnings can have a real distortive effect on pricing.
Right.
All right, I got one more of these speculation questions, and then I'm going to ask you to bring up the S&P chart, Lance. So again, let's hope nothing happens further from here on the terrorism front. Now we are likely to have deportations coming up in 2025, and the intention is to have mass deportations, right? And it's probably not going to go 100% tranquilly, right? There will be people that resist. There will be probably demonstrations amongst people that are, on the side of the anti-deportation side. You're certainly, I think, going to have media images and stories of, crying families being torn apart, that type of stuff. I mean, this is something that you're not going to be able to do pleasing everybody, right? Um,
Like tariffs aren't going to please everybody, and whenever you enact policy, you're going to upset somebody, right? I mean, that's
right,
just
right. So I think just being realistic, even sort of the best case scenarios for mass deportations are still going to have a lot of civil unrest, civil disobedience, heart-rending media campaigns, et cetera, like that. Um, as that kind of thing builds, is that something that could
does
potentially create market worries or not?
does does it impact earnings? That's the question.
Same deal. Yeah. Okay.
Right. No, I mean, look, any scenario you come up with, right? Deportations, tariffs, all those type of things. Now, tariffs, they'll impact earnings, right?
Yeah.
If I'm having to import, if I'm building a product and I import all the components from my product from China, tariffs are going to impact my earnings. So if I can't source those products from somewhere else, my earnings are going to get hurt. So, so whatever thesis you want to come up with for, say, I think the market's going to go down next year because of whatever, right? And it doesn't matter what topic you come up with. Just how does that translate into earnings growth?
Earnings.
We can certainly talk about, deportations, right? Deportations have risk. If you take a look at agricultural businesses, right, a big chunk of their work is immigrated labor, of their worker labor force is immigrated labor. Construction
Right.
has a big chunk of their workforce that comes from immigrated labor.
So let me just note this, and then you can continue. So
Right.
I just wrote down real quickly. All right, so you'll have disrupted production, right,
Mhm.
as the labor force for those industries, some chunk of it gets deported. You're going to have higher labor costs, meaning, all right, if we got to replace that labor with domestic people, and they're just going to demand more, right? And then third, you're going to have reduction in spending. I mean, these
Mhm.
illegal bodies are here and they're purchasing in the real economy. And if we get rid of them, there's going to be less purchasing there. So those are three things that are challenging to earnings.
Yeah, no, and absolutely, and that's what I'm saying. And so, but again, so we have to go back and also realize that a lot of this is stick and carrot. Tariffs are stick and carrot.
Hmm.
If you don't negotiate at the table, I'm going to hit you with a 100% tariff, right? And so we'll negotiate something, with China, and there'll be some agreement put in place, and the tariffs won't be nearly what we think, most likely, right? Same thing with Canada, same thing with Mexico, those type of things. I would suspect that when it comes to deportations, it'll be something to the effect of, hey, we're passing this, we're going to we're putting a freeze on immigration, period, right? So no more immigrating across, period, for a while. We're just going to close the borders entirely until we sort this other mess out. And then there'll be some period of, saying, look, if you're here illegally, suggest you try to figure out how to get back to where you want to go and then come back across the border, do it legally. Love to have you, but you need to do it legally, immigrate legally into the country like everybody else, right? Just over the last month, there's been a huge surge of H-1B visas, right? Mm-hmm. So this is already starting to happen. People are knowing this is coming, and so people are already starting this process now. So I figure there'll be. So what I'm assuming is, and if I was president, I was going to go down this pathway, I would figure out a way to try to ease that process as much as possible, knowing that if I do this, and again, this is the same thing with tariffs, same thing with cutting the government efficiency. We talked about this before. Is that if you start just slashing and burning stuff, and we're going around and just wrangling people up and putting them in trucks and shipping them back across the border, yeah, you're going to disrupt the economy to a large degree very quickly, and you're going to have a lot of pain. And yes, markets are going to correct sharply in that environment. I think he's smarter than that, and I think the people around him are smarter than that, and that they will approach this more tactically to where they minimize the disruption to the economy. There's still going to be some disruption. There's going to be still be impacts, and we can't get around that. And that's also why I think earnings will come down next year, is because of a lot of these policies.
Okay, great. And it's all right. I know we're totally speculating here, but that makes sense to me, which is knowing the players in the game. When it will be carrot and stick, right? But you have to use the stick early on. At least these players use the stick early on because it gives the credibility to the threat, right?
That's right.
Here's a whack or two with the stick. Now let's talk about the carrot, but I have the stick now, right? So we have this Jenga market that we mentioned, right? Those initial stick whacks are probably going to make that tower wobble some. Yeah. All right. So like I said, let's get to the S&P technicals and whatnot. But real quick before we do, I just want to give you a chance, Lance, to say anything you want about the upcoming event in Houston. That's only 2 weeks away at this point.
2 weeks away, and because of the way we had an early bird special for tickets at $99, and that was going to end on January the 1st and go up to $149, which is the full price ticket. But because of the way the week fell, and because we're in between, it fell in the middle of our two broadcasts, I've extended that $99 special through Sunday. So if you want to come to the conference, we'd love to have you. It'll be myself, Mike Leibowitz. We're doing deep presentations on markets, the economy, portfolio management, interest rates, bonds. Adam will be there. We're going to have a panel talking about everything, every question you possibly can imagine, taking live questions from the audience. So if you got specific questions, we'll take your questions specifically and address those. Richard Rosso, Danny Ratliff will be there as well to address issues on financial planning, estate planning, retirement planning, all those type of things. So we did this last year. It was very well received. We've sold about half of all the tickets right now already, just in the last 2 weeks. So I encourage you, if you want to come, to get your tickets now, because they are probably going to sell out within the next week or so.
Okay, so be directive. Where should folks go to sign up?
The easiest place to go is just simply go to our website, realinvestmentadvice.com, and right there at the top of the webpage is a blue banner that has the link to sign up through Eventbrite, and you can just go to that link, pay, get your tickets, the whole 9 yards. Also, if you go to our Substack page and follow me at Substack at Lance Roberts, I also have been posting that. Our newsletter will be out tomorrow, and there's a big banner inside the newsletter tomorrow morning, also with that same special rate. So you'll be able to get that there as well.
Okay. Well, I'm really looking forward to this. It's going to be fun. It was a lot of fun last year. Folks watching, if you've ever, wanted to sort of see how these weekly market recaps get created and would like to be, at the table, that's what we're going to be doing there, which will be real fun. And the interactivity, I think, is what I get, the most out of this. It's always fun to hang out with you and the RA team in person, Lance, but it's the chance both to interact on and off stage with the audience. But as we like last year, as we, did our version of the weekly market recap live, and then folks started lobbing their own questions in. It just made it a lot more of an interesting event. And of course, then we start doing just a lot of Q&A with the audience. And when folks in the audience realize, oh my God, I can ask this brain trust of, RIA experts anything, then it just gets crazy in a fun way. So, all right, folks, we'll hope to see as many of you there as possible. All right, so Lance, if you can, bring up the chart of the S&P, and then I've got a little, fun announcement for folks after that.
No problem. Real quick, just to on our previous conversation, just
Yeah.
about implementation policy. One thing to also note is that even though the Republicans control the House, the Senate, and the presidency, which in theory would make it easier to pass policy, the Republicans have the slimmest House majority since 1931. So it is not a big majority by any stretch of the imagination, which means that a lot of these policies may run into trouble getting passed. So while there's a lot of hope that we're going to see big deregulation, further tax cuts, et cetera, I think the reality is we may see some deregulation, see an extension of current tax cuts. In other words, the tax rate cut that we had in 2017 won't go back up in 2026, but that's already factored into earnings, right? You're not getting any boost from just extending the tax cuts. So you really would have to cut taxes more and go from 21% to 15% on the corporate tax rate to really get an impact. And that may be much more challenging to get passed. So we'll see what happens. But again, I think it's worth noting that a lot of this is based on the assumption we're going to have this slate of policies getting passed, which may not turn out to be the case.
And this goes to the question that I've raised to you in the past, which is, may Inauguration Day kind of be a buy the rumor, sell the news type of event where animal spirits got real excited that Trump got elected and he has all this disruptive change he's going to do, but they begin to realize, oh, you know what, this might just get snarled in traditional DC gridlock, or yeah, maybe some of it gets implemented, but it's a fraction of what everybody was expecting initially.
Exactly.
Because it's got to be more bipartisan. Yeah.
Yeah. So just talking about the markets technically, again, we've had this bit of a correction here over the last couple of weeks. It started about mid-December. And again, if you go back to what we were talking about early in December, we said that we had this pretty strong rally post Thanksgiving, and I said, hey, be careful, because when we get in the second 2 weeks of December, you typically get portfolio distributions, you get sell-offs because of the distributions. And we saw that. Then we had the rally that came back, so market rallied back. Really kind of into Christmas. And so I got, okay, good. We're getting we've had the distributions. We're not having the Santa Claus rally. So we had this rally back in heading into Christmas, and then it all kind of fell apart after Christmas. But, we've had a couple of warning signs in there that we talked about, right? We were on a MACD sell signal that suggested that, prices could be weak. And so that sell signal was certainly keeping us a little bit more on the cautious side with our portfolio exposure. And then we've had relative strength, getting fairly oversold now. That's that top graph in this chart I'm showing you is relative strength. So relative strength has been declining. The momentum of the market, which we measure through, kind of the MACD indicator, that's been declining. So that's all suggested that this kind of correctional process we've been in is certainly notable. The bottom chart is the number of stocks on the S&P trading above the 50 and the 200-day moving average. So the red line is the number of stocks trading above the 50. The black line is the number of stocks trading above the 200. That breadth has been fairly weak and declining, and now we've reached levels. So I went back and I drew these blue vertical lines. You'll see that whenever breadth has been this negative in the market, that's typically been close to a bottom. So, this is one of the reasons between the markets being fairly oversold on a momentum basis, oversold on a relative strength basis, being oversold on a breadth basis. There's really a potential here that we could see, and this is why I think we'll see a rally kind of go here from here to about January the 20th. Now, once we get through inauguration, it's really kind of hard to tell what's going to happen after that. But I do think we're set up decently now for a tradable rally. So I wouldn't really be making major portfolio changes right here, like, I need to sell stocks and get out. I wouldn't do that here. I think you'll get a better opportunity over the next couple of weeks.
Okay. All right. So we'll get to RIA's trades before the end of this video, but it sounds like you guys, are kind of, sitting with whatever allocation you had coming into the new year and not making any major surgery right now.
Right, no, yeah, exactly, and just I've got a portfolio that I spec trade in, and just it's my personal, and I just bought some S&P long calls to that run out to February the 15th. So I'm just betting on a trade here in the markets over the next couple of weeks, and because I think there's a decent setup for it. So just picking up a little bit of volatility on the bet. So we'll see. We'll kind of see what happens. It might work, it might not. But I do think there's just a reasonable setup for it. And again, just technically, we're kind of set up for it. And we're also really kind of looking at potentially here to see a rotation within the markets as well. So I've showed you this before. This is from SimpleVisor, but we track the different sectors and look at their absolute and relative score. So absolute, so you understand, an absolute score is what is the sector doing itself. So, for instance, basic materials on an absolute basis is down 0.77, right? So it's been under a lot of pressure. And this has been very interesting, right? Because everybody's talking about such a strong economy. We're going to have 2.5% growth in GDP, or actually near 3% growth in the fourth quarter, blah, blah, blah. But yet basic materials, industrials have been under a lot of selling pressure lately. So again, and a lot of that has to do with end of the year and some other stuff. But it does kind of run contra to this idea we've got such a strong economy when you're seeing basic materials and industrials in particular struggling so much. Relative score is how is it doing relative to the S&P. So materials is underperforming the S&P on a relative basis. So absolute, how's it doing against itself? Relative, it's how is it doing against the S&P. And what you'll notice is the sell-off in the market, this chart to the right, you'll see that all of those sectors, other than communications and financials and technology, are pretty much all down in the oversold category on both relative and an absolute basis. So, what that's telling us is that we're probably set up now for a reasonable rotation in the markets. We might see a little bit of selling pressure come into, say Meta, some of the communications like Meta and Google, which have had good returns, Tesla on the discretionary side, and see some of that rotate into some of these more oversold areas like industrials, materials, real estate, utilities. We could see a bit of a pickup there.
Okay, and Lance, I just want to remind folks, all these charts you're going through are from your SimpleVisor platform.
Right.
SimpleVisor is such a cool tool. I feel like we should probably do on, a relatively near-term upcoming recap like this, a refresh of the SimpleVisor tool.
Yeah,
and I know that there were some feeds and stuff that you've been working real hard to get in there. Are those almost ready? Maybe we do it when those are unveiled.
I was going to say, so as we talked about last year, we were going to launch, basically a whole new suite of portfolios. So right now, if you go to the website, you can track, the current portfolios that we run, our equity portfolio, our ETF, and our dividend equity model. These are live portfolios. They're tied to live accounts. And so whenever we talk about making trades, they're all represented here. Well, we're going to add 10 more of these models to the site, but we had to set up a new banking relation, or a new custodial relationship with Pershing. And so we've now completed that process, and the company we're working with to launch these live portfolio models and onboarding processes, et cetera. So you can just go open your own account, pick a model, invest your own money, it'll go right into that. That's all being set up by Advisor Engines. That should be done in theory by the end of the month. But we're very close to now getting all that launched. So once we get all those models launched, then we come back and do a full recap.
All right, let's plan to do that. Hey, just because folks are probably looking at it like I am, you've got that column P&L since inception.
Yep.
When was inception?
So the equity portfolio, it incepted January of 2019. So the ETF model did too. And then the dividend equity model launched in March of last year.
Okay. All right. Okay. So I interrupted you. So continue marching through this stuff. But I did just want to remind folks about the fact that A, SimpleVisor exists, and B, it's like a Bloomberg. There's just so much unbelievable data and analysis there available at your fingertips.
Yeah, and that's one thing I wanted to kind of talk about too, is that if we were talking about this kind of rotation in the markets, and when you start looking at all the various factors, and we kind of, and one way to kind of look at this is if we set this up on 20-day rolling periods. So let me just update this real quick. So this is what's happened over the last 20 days. Let's sort this by category. So over the last 20 days, the next column is the 20 days before that. The next column is the 20 days before that. So this is 60 days of performance, so forth and so on. But over the last 20 days, you remember we were supposed to be having this renaissance in small cap stocks. Everybody was like all excited, small cap's coming back, I want to be a long small cap. It's down 4.5% in the last 20 days. Small cap value has been under tremendous pressure. Mid cap growth has been under tremendous pressure. So, everything that everybody thought that was going to do well completely fell apart. And everybody that thought that the mega caps were all going to, remember, we're going to have AI's over, AI's dead because of the past summer. You don't want to be long AI stocks. Well, they've been the best performers over the last 20 days. They're up 2%. Mega cap growth is up 1.6. Momentum is basically about flat. So, what we're seeing is now, again, that's going to potentially rotate. And when you start to see these kind of big divergences between one sector of the market and another, or I should say one factor of the market and another factor of the market, those are typically good indications that you're going to get a rotational move in the markets. And I think we're getting set up for that. And so I think it's worth paying attention to that, when you start seeing these type of rotational, deviations occur, that's generally a good time to start thinking about kind of rebalancing your portfolio a little bit. So for instance, one thing we're thinking about doing in our portfolio is we've done really well on Amazon. So we'll probably trim off Amazon and then maybe add into some of our utilities or real estates that are basically a bit more oversold in the markets right now and underweight, and then kind of try to pick up on some of that rotation trade in the market.
Okay, so just to be super clear, you'll be trimming growth and buying some of this mid to smaller cap stuff or more boring industries that haven't performed so well, and try to ride that. That's the rotation you see happening.
Yeah, well, that's what normally happens, and so it's certainly. And again, here's a good example of this. So again, so 20, 40, 60, right? So 60 days ago, small cap, mid cap up 2.4%. Large cap growth, mega cap growth was basically zero. So again, that's where we were seeing that rotation previously. This is what everybody was all excited about, and then it completely fell apart. So, that's, so again, we'll kind of see that same type of environment occur, and I think it could be short-lived, but I think we'll see some of that rotation.
Okay. And you've, I believe you have said that you expect volatility to be higher in 2025 than it was in 2024. Meaning this type of strategy of playing these rotations will probably be a effective way to, or should be a more effective way for an active manager to pick up gains, right? Because the more of those rotational cycles you have because of volatility, the more chance you have to ride them, correct?
That's right. And again, because last year was clearly a stock picker's market, right? If you had the right stocks in your portfolio, you did great. If you didn't, you didn't. And it was very clear about that. So if you owned a bunch of deep value stocks last year, your performance was terrible.
Sorry, I want to interrupt because you're correct, but also it was a good year for people that just bought the index.
Yeah, but again,
and I say that because 2025 may still be a stock picker's year, but not a great year for buying the index.
Right, and that's true. But again, what drove the index last year was the 10 companies that make up 40% of the index. Yep. So, that's it's back to that whole passive investing flow model, right? And we had we had over $1 trillion flow into ETFs last year. The most on record. We're talking about liquidity. It's just been absolutely amazing. We didn't even have that type of flow in 2021 when people were getting $1,500 checks to their house, right? So, it's just interesting. We've seen such a massive flow of liquidity into markets. It came from foreign individuals. We had a lot of foreign inflows into the country. That's why the dollar's been going up. We've just had tremendous flood of that. And that's all flowing into, ETFs. And again, we're seeing a lot of it. We've had a massive surge in leveraged ETF flows, massive surges into, single stock leveraged ETFs as well. So the speculation in the market has just gone parabolic. And again, That's going to end badly at some point. The question and the question will be is how does that occur? Because, go back to 2022 as a good example. If you own the big mega cap companies, yeah, your portfolio was down a little bit in 2022. We were down about 20% overall in the market. So survivable, not the end of the world. But if you owned a bunch of those high, kind of highly speculative meme
Right,
stocks,
those ARC stocks, yeah, you got crushed.
yeah, you got absolutely. I mean, ARC, Kathy Wood's ARC Innovation Fund, it was down like 80%. I mean,
Yeah.
because absolutely decimated. So, this is going to be, and this is one of the interesting conversations when people are talking about, oh yeah, we're going to have a major market crash and this is all going to occur and people are going to lose all their wealth. That is absolutely true if you own a bunch of fundamentally broken companies, which are the ones that everybody's chasing right now. If you own good fundamental quality companies that have earnings and growth, you're going to survive just fine. Doesn't mean you're going to make money, but you're not going to get decimated.
All right, got it. All right, anything else on the simple master side you want to walk through?
No, I was just going to show you this one chart here. This is one of the things that we watch. We watch money flows very closely, and again, when money flows are shifting, those are good indicators that you kind of need to be position yourself accordingly. And again, we've seen, we got a money flow trigger back in early, kind of that second week of December, and that's been kind of telling us that the market's going to be weak. And again, when we kind of look at the market, the money flow indicator is now getting low enough that it's probably about to start to turn. So we'll start to see kind of money flows come back into the index, and that's why I think there's a tradable rally here to pay attention to, at least for the next 2 to 3 weeks, maybe the next month.
All right, and this obviously again goes back to liquidity flows, right? If the money starts pouring back in, you expect prices to go up.
Okay.
All right, so real quick, folks, I mentioned I had a nice little announcement for you. So those who watched this video last week likely heard me announce that one of the new content releases that we have coming up for this new year is that Stephanie Pomboy is going to start appearing on this channel bi-weekly, and she's going to appear. She's going to give some of her most recent observations from the research that she does over at Macro Mavens. And then there's going to be an interactive component where the audience can ask her whatever questions they want. This is something we're going to trial for, who knows, a couple of months or so, see how it goes. And if everybody likes it, it'll become a permanent part of the content rotation. So I invited Stephanie on the other days just super briefly to just give a couple minutes discussion about what you folks can expect. Here it is. All right, folks. Well, I'm super excited to be here with the wonderful Stephanie Pomboy, who is going to start appearing on this channel with her own segment early in 2025. Stephanie, so wonderful to see you.
Thanks so much for having me, Adam. I'm really excited about this idea. So I'm glad to chat about it with you quickly today and
All
kind
right.
of
Well, look,
tease the audience a little.
yeah, I mentioned briefly last week that we were going to start this really sort of as a trial. You obviously write tremendously respected research over there at your website, Macro Mavens. You've got an institutional audience, you've got a retail audience. You're one of the absolute most popular people to come on Thoughtful Money for an interview. No, it's just true. It's like that SNL skit with Will Ferrell, more cowbell. People have just always been asking for more Pomboy. So with 2025, we are answering that where you spend a lot of time writing your wonderful reports. You get a lot of information and insight in your head afterwards. What we want to start trying to do here is provide you an outlet where you can come on some sort of occasional basis and do sort of a debrief of what is most on your mind, on whatever week you appear. But then also it's going to be interactive. You're going to be taking live Q&A from the audience here. So I already got just tremendous feedback from folks who heard my brief announcement who were super excited. So I thought I'd bring you on here just for a minute to kind of further excite folks, but also sort of set expectations. Just tell them what you're hoping to do with this new segment.
Well, honestly, I guess it's a little bit of forcing myself out from under my desk because I hit the send button on that commentary each week and then I get back on the hamster wheel and start looking at other things I want to write about. But what I really need to do, and I really find I enjoy the most, is interacting with people, talking to them about what is on their radar? What are the things that they're looking at? What are they concerned about? What opportunities are they seeing? You know, what kind of questions do they have about the economy or the markets? And that give and take is so important, I think. And I don't do enough of it. So this is kind of a vehicle for me to kind of force myself out of my JD Salinger role over here and interact a little more. And I think it will be, well, I know it'll be hugely beneficial for me to be able to hear what kind of things people are really focused on out there, and be able to have these conversations. And hopefully people will find it interesting and valuable to them as well. You know, I can certainly hold forth about all the statistical shenanigans that I see taking place, and what I see when I do the deep dive into the economic data. So I'll be happy to take their questions, but I'm also really curious as to what's on their minds.
Well, Stephanie, I've got 100% confidence that it's going to be tremendously popular. I want to again appreciate your willingness and interest to do this. I'm going to apologize in advance because I think it's going to be a bit like drinking from the fire hose in terms of you getting that interactive feedback that you want.
I hope so. I hope I would enjoy that.
All right. Well, look, folks, I hope you feel excited for this. Steph, the first one of these is going to start. What date did we determine? Was it Monday, January 6th?
Yeah, the first Monday of the new year, January 6th. We're starting that New Year's resolution right.
All right. All right. And folks, that's going to be at 11 a.m. Eastern, 8 a.m. Pacific, the normal time in the mornings that Thoughtful Money's videos launch. So anyways, folks, if you're super excited, let Steph know in the comments below the video here. But Steph, super thrilled for this. I guess just to put you on the spot, if you had to pick a word that you think, given your outlook for 2025, is going to describe the year aptly, what word would that be?
It's so trite, but I'm going to say volatile. That would be my word. So
All right. So basically get ready for a bumpy ride.
Yeah, I don't think it's going to be the smooth sailing that seems to be the forecast right now. So, but I always like to have some contrarian views and a flair for the dramatic. So volatile will be my word.
All right. Well, sounds great, Steph, and I can't wait for this thing to start. I'll see you on the 6th.
Me too. Thanks so much, Adam.
All right, folks. Well, I hope you're as excited for that as I am. And as a reminder, that is this coming Monday at 11 a.m. Eastern, 8 a.m. Pacific. I hope all you can watch it there. And please give Stephanie a big, warm, Thoughtful Money welcome. All right, Lance, let's see here. I'm making my way to what will be today's rant, although it's going to be a fun, positive one. It's based on an article that you just released, Bob Farrell's 10 investment rules. These are sort of timeless pearls of investing wisdom, so folks stick around for that. Before we get there, two things I want to get your reaction to. One of them, Lance, is just noting this chart of the US dollar and the fact that it has broken out to the upside of the channel that it's been trading in. So I think we're all familiar that the dollar has performed fairly well versus other fiat currencies, relatively recently. You can see here from this chart, this multi-year, 2.5 year or so channel, trading range channel. The dollar has now punched above. Okay, when you look at this, what are you taking away from it? Is this a blip? Do you expect it to crash back into the channel? Will this dollar that's too strong start weakening, breaking things around the rest of the world, and this will self-correct? Or could this be the start of a new era? And if so, what would define that era?
Well, I wouldn't call anything a new era, and this is, because nothing's changed, right? So, right now the dollar's doing well because we have stronger economic growth than any other country in the world right now. As we talked about last week, Germany, UK, China, they're all on the verge of recession. Japan.
Pretty much everywhere but India, yeah.
So they're all on the verge of recession. So that's attracting flows into the dollar. You've also just got, again, you've had just stellar performance in the U.S. index. It's just sucking in capital into the U.S. to be invested here because why would you own an emerging markets or international, right? I mean, why would you have your money there if you have the S&P index? So again, you're just seeing a lot of this flow of money into the U.S. dollar, and that's mostly reserves and other investment capital. So again, the dollar could certainly rally stronger from here. There's really nothing to stop it here. But as the economy weakens into next year and the year after, and as we turn back more towards 2% growth, I would expect the dollar to probably start to kind of revert back to that trend channel, because that's a good kind of a balance. And again, when you're talking about the dollar, you're not talking about the dollar. You're talking about the dollar as it relates to a basket of other currencies. Mm-hmm. So our dollar right now is stronger than that basket of other people's currencies. Theirs are weaker than ours. And as you noted, that impacts trade. And so at some point, we will intervene into our dollar and we will weaken our dollar. Or other countries will intervene and strengthen their currencies relative to ours, because it's in their best interest to keep that peg ratio more in line than not, because that impacts the value of trade and impacts the cost of their inflation, all those type of things. And particularly if you're a company that heavily imports goods, that's going to be very important. If you're a big exporter of goods, it becomes a much bigger problem, right? Mm-hmm. So if you get too far away from that peg, it becomes a real drag on you economically. So again, I would expect the dollar to return back to that kind of long-term channel at some point. It won't crash back down or anything like that, but unless we fall into a recession, then it will. But yeah, get back in that channel where it's a more of an equal balance and keeps trade globally in kind of good stead.
Okay, so basically you're saying sort of cure for a high dollar is a high dollar, and you expect as the dollar remains this high, maybe even goes a little higher, that's just going to slow the U.S. economy even further, and then that will eventually self-correct.
And this is the whole fallacy. When we were writing articles a couple of years ago, because everybody was like, "Oh, it's de-dollarization and the dollar's going away, and it's blah blah blah," and we're like, "No, that's not the case." 75% of all SWIFT, or 70% of all SWIFT transactions are all in dollars. But it's just a function that the dollar is going to move up and down relative to other currencies based on all kinds of international dynamics, and that's just a function of how it's going to work.
Okay. All right. I want to get your thoughts on this chart, which I'm calling potential white swans for 2025. Okay. You and I talk a lot about potential black swans, and of course, you always remind me when we have this discussion, a true black swan is something that we're not even thinking of, right? So right. These are risks that market participants are thinking of and worried about. So this is basically saying, what do you think are the biggest risks to market stability in 2025? And I just want to read the top 5 or 6 and then get your thoughts on any of them, right? A global trade war, which funnily enough wasn't really on folks' radar when they asked this last year. But of course, with Trump now the president-elect, that has definitely changed things. Number 2 is tech valuations plunge, AI enthusiasm wanes. And I would put this in the category that you were talking about earlier, just about stretch valuations. That's because they tend to be the biggest driver of today's valuations. Yep. Central banks hike unexpectedly as inflation is sticky. That's definitely something we've talked a lot about, not exactly to the point of central banks hiking again, but the fact that inflation is being stubborn, although I know you've been on record many times saying you're not that worried about it. You think it's going to continue to get dragged down for reasons you've explained. Kind of related to that, bond yields rise more than expected. I think many people would expect, were that to happen, it would be because of sticky inflation, but it could be because of other things. Escalation of Mideast tensions, or the Russia-Ukraine conflict, which is a few more down the list. So we'll call that geopolitical risk. And then the last, U.S. hard landing. So those are the top ones. Very notable that fears of a U.S. hard landing are much lower than they were a year ago. But those are the white swans that are currently, circling overhead. Any reaction to any of those, Lance?
Well, yeah, I mean, this is a great example of why you should not pay attention to this stuff. Because again, all these, with the exception of the first one, which was because of tariffs, but all these were concerns last year. And if you had bought into those concerns last year and said, well, I'm not going to be invested because, this is going to occur, you're wrong. And
sorry to interrupt, but look at that. 40% of respondents were worried about a U.S. hard landing. It was the biggest one last year. And this year, less than half right?
Yeah.
Worry
So,
about it. Yeah.
and so, but actually, this is a great example of what we'll talk about in a second. But Bob Farrell's rule is when all experts agree, something else tends to happen.
Yeah.
And, so if all experts agree that a global trade war is the biggest concern, probably not going to have that. Maybe the one to be paying attention to there is that 2025 is likely to be without major risk.
Right. Yep.
That's the one we need to be paying attention to, right? Because nobody expects there to be a major risk, which maybe we could come out. And again, whatever shakes up the market won't be any of those on that list. Read that list top to bottom, snapshot it with your phone as you're watching the video, save it. None of those are going to impact the markets this year, because the thing that will trigger a market decline is something that occurs that's not on that list. It has to be. These are things that the market's already well aware of. They've been talking about it for 2 years. Markets have already priced every one of those in. The one thing that they haven't priced in is all of a sudden you have an EMP blast that knocks out the entire power grid across the US.
No, you thought of it. Someone's already priced it in, Lance.
But yeah, it's got to be something like that. It'll be, and it'll be really, honestly, it'll be something credit related. Something will break in the credit markets. You'll have a major, like one of the major banks fails for one reason or another, whatever it is. And that's what will cause the cascade sell-off in the markets, but it won't be any of those.
Okay. I totally agree with basically everything you just said there, but let me just ask the question. So let's look at tech valuations plunge, right?
Okay. Why?
Doesn't mean they can't, right?
Sure.
I mean, sometimes when the crowd sees the out of control tractor trailer, barreling into it, yeah, sometimes it actually happens, right? So, valuations are very stretched. It's not a guarantee, but it's not a guarantee it's not going to happen either, right? So what is the incident rate sometimes of just the thing that is obvious actually happening?
Very, very, very rare. Because again, the market's already aware of this. And so the market's already priced it in. And again, so great, tech valuations are going to plunge. So let's just pick NVIDIA. So for NVIDIA's price valuation to plunge, right, you've got to have one or two things happen. Either earnings stay where they are and the price goes down dramatically, or the earnings plunge for one reason or another. So what you have to make the case of is that all of a sudden everybody's going to say, yeah, that whole AI thing, I'm not going to buy it anymore, right? This is kind of the same thing as people in 1999 going, yeah, the internet fad thing, it's never going to stick, right?
Right. But it did. But the prices didn't, right? I mean, there was a correction.
Prices of the companies that crashed had no earnings, and most of them had no real internet strategy. They just stuck .com on the end of their name and rode the wave. So some of that's going to happen, mind you, absolutely. But if you're talking about tech valuations, companies like Palantir or Palo Alto Networks or NVIDIA, Apple, Microsoft, you've got to make and again, I'm not saying that it can't happen, but you've got to make the case for either A, the market just says, I'm selling everything because I don't believe in the AI story anymore. That could happen, right? But something's got to occur to get that thought process.
Yeah.
Or all of a sudden everybody just says, yeah, I'm not going to buy Microsoft products anymore. I'm not going to buy any more Apple phones. I'm not going to buy any more NVIDIA chips. And then their earnings go down the tubes and then the valuations crash. So you've got to, it's really a very stretched reality that that's going to occur unless there is some type of event that comes along that all of a sudden changes the fact that Americans are now shuttered in their houses and they're not buying these products anymore. And all of a sudden we've got to change that we're not going to generate earnings growth at the rate we thought they were. We're going to have to reprice the market. That can occur, but we've got to have an event to cause that recalibration and thought.
Mm-hmm. So I guess we're going here because the tension, right, is the markets are at these very historically extreme valuation ratios, right? So predicting a price correction, it's not rocket science, right? The rubber band's really stretched, right? And it's mostly the tech sector that's stretching it, right? But I think what you're saying is the risks we know to that valuation right now are priced in the market. So it's going to have to be an event that causes people to reassess that risk even more so than they are today.
So great example, right? 1998, 1999, everything is fine in the dot-com world, right? Everything's great. I mean, it doesn't matter. You have a company out there. And there was this little company in Houston, Texas, that in 1995, they were just this little energy company, had a little pipeline. And they go, we have an idea. We're gonna jump on this whole internet thing, and we're just gonna create all kinds of product, and we're gonna sell bandwidth, and we're gonna do all this kind of cool stuff with the internet. And they had a really great idea. And so everything's fine in 1998. It's fine in 1999. And then in early 2000, there's an analyst that asked Enron a simple question and said, yeah, I'm not buying this growth story you've got. And immediately the world fell apart, because all of a sudden, all the assumptions that were based on growth, and a lot of that was tied to Enron at the time, about how fast Enron was growing, and everybody else thought they could keep up. They were all going to be the next Enron, Global Crossing, Lucent, all these other companies. All of a sudden, WorldCom, can't forget Bernie Ebbers and MCI, right? So everything was tied to that. And all of a sudden, when Enron became the poster boy for fraud, the entire world, everything you thought you believed about earnings growth was wrong. And everything got scrutinized. And all the rats and roaches came out from underneath the refrigerator. And everything fell apart. So you've got to have that type of event. Same thing in 2007, 2008. Subprime's contained, everything's fine. And it was, until people realized that there was no buyer for Lehman's bonds.
Right.
They went bankrupt, and you froze the credit market. And so this is my point about these, predicting crashes. The reason you can't predict a crash and you can't predict a valuation reversion is because you can't predict the event that's going to make it happen. People will overpay for assets as long as nothing changes the underlying fundamental reason for why they're overpaying for that asset, which is the hope for growth.
Yep. And I guess the only thing I just wanted to underscore, given my line of questioning here, was don't look at that list and say, okay, well, look, tech stocks can't correct in 2025 because Lance says everybody's expecting it and therefore it can't happen, right?
No, you need an event to make it happen, though.
Right. Yep. Okay. All right. Well, look, as we wrap up here, Lance, we'll get to your trades after this next segment. But if you can, let's pull up your Bob Farrell's 10 investment rules and just walk through them in any depth that you want to. Maybe highlight one or two of the ones that are particularly meaningful for you in guiding your investment philosophy.
Yeah, so I actually wrote this article first time back in 2016, and just recently, because of where markets are, and again, I'm certainly concerned about valuations because I am a fundamental investor. At the end of the day, we've been talking a lot about Bob Farrell's rules lately on the Real Investment Show, and so and again, I've touched on these rules before, and since it's the beginning of the new year, I thought I'd just go back and revisit the list. And what I did back in 2016 is I illustrated the rules. So I put graphs and charts in with each rule to kind of explain what the rule is about. And so I just updated that article to give you all of the kind of the new illustrations. And so, the reality is so rule number one is that markets, tend to return to the mean average price over time. And we see that now. A reversion to the mean doesn't necessarily mean a crash. We've had multiple reversions to the mean ever since 2009. And we've still been in a bull market. Now, eventually, the markets will take out that mean and we'll be in a bear market again. But, when that occurs, we'll see. But that's going to take a much bigger correction. But one thing to kind of take a note on is again, what you and I were just talking about, the price deviation from the long-term mean. So this is the deviation from the 52-week moving average. So this is a one-year moving average and how much the market is deviated from that. And currently right now, we're at kind of those upper ranges that have historically led to a price reversion of some sort that got us below that one-year moving average. And again, we saw that back in 2022. We had that correction that pulled us down, and we saw it back, and you can barely see it now, but that 35% correction in March of 2020, certainly took us below that mean. Of course, you know, also more clearly see, you know, 2008 and 1999, 2000. So, you know, these reversions regularly happen. So, you know, importantly for his rule is that understand that mean reversions do happen and you need to be aware of them because they are very important to understand. Excesses in one direction will lead to an opposite excess in the other direction, kind of obvious. But again, this just looks back over the last, you know, kind of 15 years. And
Hey, Lance, just expand the chart a little bit.
sure, absolutely.
Trying to
So
be boomer friendly.
yeah, no worries. But yeah, so when you get, you know, kind of well deviated above the 50-week moving average, like we are now, you should expect a correction back towards the bottom of that moving average, right? So again, a 2 standard deviation move to the other side of that, reversing those kind of more extreme should be an expectation. And again, going back, looking just over the last 15 years, we've done that regularly. And so we're now kind of pushing up there. And this is why one of the things I think we could see in 2025, 2026 is that we're going to see some type of reversion market. Again, not necessarily a crash. It could just be kind of a slow grinding pullback, kind of like we saw in 2022, that gets you to the other side of that overbought condition. And we're certainly there. And we certainly have the potential to retrace that. And that would be about a 25, 30% decline to get that stuff done. But again, that doesn't mean it happens all at once. It's not a crash. Something that'll give you plenty of time to navigate through, but something that as investors, excuse me, I think we just need to be, you know, a little bit aware of. And again,
Hey, Lance, sorry, real quick, just on that chart. I think in your article there too, Bob mentions that when they tag the top line there, the resistance line, they don't correct by going sideways.
That's correct.
So it is a price decline. Now it might be grinding, as you said. It might not be just an elevator drop, but it's highly unlikely that it's just going to be a sideways market for a prolonged period of time.
Right. Well, and again, you know, here's a good example. Take a look at 2013. So in 2013, you tagged the upper end of that resistance line. You go, oh my gosh, the market's going to correct next year, right? So I'm going to get out of the market. I'm going to wait. Well, you had to wait all through 2014, all the way into 2015, and got into 2016 before you had a correction, right? So sometimes these more extreme deviations, they can last that way for a whole lot longer than you think, and you can miss a lot of market by, you know, trying to get out too early. So again, this is why we pay attention to this stuff and we pay attention to the technicals and those type of things. But this is the inflation adjusted deviation from the long-term exponential growth trend going back to 1900. Again, we are the most extreme deviation from that long-term growth trend ever on record, right? We have to go all the way back to early 1900 to get there. Previously,
that is crazy. I think so few people understand how stretched this is on this metric here.
And again, so your first thing is like, oh my gosh, the market's going to crash. But again, you know, you can go a very, very long time without a crash occurring. And again, we saw that back in, back in that second peak right there was this stimulus surge, 132%. That was just before COVID set in. And right after COVID set in, you had the correction and then right back off to the roof because of all the stimulus. So, you know, these deviations can certainly last, and I think they're very important to pay attention to. And we're certainly watching them very closely because we will eventually have a reversion. But again, we're going to have an event that causes a contraction of liquidity, and what causes that is going to be the much bigger challenge to kind of navigate. You know, this is kind of all the previous bubbles going back through history. And, you know, kind of his point is that, you know, this time is never different. You know, investors always say that, oh, well, this time is different. And going all the way back to 1600, there's always a reason why this time is different. You know, it's the Gilded Age, it's a new era, it's commodities, it's gold, it's portfolio insurance, you know, long-term capital management, all those issues that we said, oh, this is the reason it's different this time. It wasn't. And because, again, it's at the end of the day, it's all about fundamentals and being able to maintain those. So there's no new eras. AI isn't a new era. The excess will never be permanent. AI will eventually end, just like .com eventually ended. I'm not saying it's going to crash by 50, 60, 70%, but this isn't a new era. This era will end, and then we will have to navigate what that means when we get there. Again, you know, some of these are a little bit repetitive. Exponential, you know, rapidly rising or falling markets go further than you think. They don't always correct by going sideways, as you just said. again, we've seen this before. Importantly, I think this is a good one. The public buys the most at the top and the least at the bottoms. And right now we are at a record level of household equity ownership. And so households are in up to their hilt in buying stocks. So again, if he's right, and again, we've seen this before, is that whenever we get to household equity ownership at more extreme levels, that has typically been the peak of a market, not the bottom of a market. And number 6, I thought is very interesting here too, because fear and greed are stronger than long-term resolve. And I think this is a great explanation of what's going on in the markets right now, is that people are very, very greedy in the markets. And we've got investors that are heavily allocated, both professionals and retail investors. They are fully allocated to the markets. Household equity allocations, professional allocations are all at very, very elevated levels. And that's something that normally occurs at the peak of markets, not at the bottoms of markets. And again, this is why Warren Buffett says when people are fearful, that's when you buy, and you sell when people are greedy. Well, right now, people are greedy kind of across the board. We talked a little bit about market breadth. And markets are strongest when breadth is broad, weakest when breadth is narrow. Certainly have a very weak measure of breadth in the markets right now. So again, that's why markets have been weak as of late. Bear markets have three phases. They have a down leg, an up leg, and then a third phase, which is where the wipeout occurs. The reason
is the crush your soul phase.
Yeah. The reason this is important is also this was 2008. Now we haven't had a bear market a real bear market since 2008. So people really don't know what a bear market looks like. But even in a bear market, you have time. And again, this is the big worry for people, right? Is that I'm going to wake up one morning, I'm going to lose 50% of my wealth. Unless we shut down the economy again, which was a 35% decline over a 3-week period, that normally doesn't happen. These 50% corrections that occur take months, and the markets give you plenty of opportunity to realize that there's a change going on in earnings expectations, earnings growth, market dynamics, etc. And they give you plenty of opportunities to reduce your portfolio risk, get out of markets, those type of things. And this is one of the reasons that when people are going, oh, the markets are going to crash 50% next year, that's really bad advice for people, because you're not going to, and people go, well, I'm not going to be in the market now because I don't want to lose 50% of my money. But markets don't crash overnight by 50%. It takes time. And so you don't need to go panic and get out of the markets right now. Just pay attention to what the markets are doing. And then when we get into the beginning of a bear market, we'll know it. And we'll see the changes to earnings. We'll see the changes to outlooks. We'll see those changes, and we'll know that we're shifting that dynamic psychologically within the markets that are going to drive prices lower. And we'll have opportunities to sell out of the markets long before the actual soul-crushing phase 3 that you're talking about actually occurs. And that takes time to get there. And so again, paying attention to your portfolio, paying attention to risk, and this is when we talk about risk management all the time, is a much better way to navigate. And again, this is just kind of talking about earlier about your list of outcomes. Going back over the course, when all experts agree, something else tends to happen. And at periods, I just went and pulled headlines from different periods. Plenty of room for this bull market to run in 2014. Then in 2015 and 2016, you had 20% corrections, right? S&P doubles fastest in bull markets, and then you have the crash by 20% in 2022. So, experts are wrong almost all the time. And so really listening to financial news headlines is a great way to be pretty much on the wrong side of the market most of the time. So again, go back to just focusing on what drives markets, which is earnings, it's fundamentals, it's those things. And most importantly, just control your emotions, because again, greed and fear are where investors make their worst mistakes repeatedly over time. And this is why we just really focus so much on trying to control, again, when people come on and they're saying, oh, the end of the world is coming, that's fine, but that's feeding into the fear dynamic, which leads us to make bad investment decisions. When all we have to do is pay attention to what the markets are doing and allow logic to control our actions, and we'll be better investors over time.
Yeah, totally agreed. We talk a lot about the importance of psychology and how it generally works against us here. Real quick, Lance, just scroll back down to that psychology chart again for a sec.
Yeah.
That's probably one of the most important charts out there in understanding the progression of psychology. Now, what it doesn't tell you in any given moment is the timeline that curve is going to be followed on, right?
Right.
So, I don't want folks to expect that, hey, if we're at discouragement, that things are going to start getting better tomorrow. If we're at euphoria, things are going to start getting worse exactly tomorrow. But given your long market experience, what stage would you put investor psychology in right now?
Oh, we're definitely in the exuberance euphoria stage. We're somewhere in there, for sure. But that means that this market rally could last another year or two.
Right, that's what I was talking about timing. You think, oh, we go straight from euphoria to anxiety, but that could take years.
It could take a couple of years. And again, you have to remember, it's the markets are like a train. And when you have the whole herd, again, everybody's investing in the markets right now. Everybody's just, can't wait to get money invested in the market. So if you think about the market like a speeding train, it takes a long time to slow that momentum of the train to a stop. And that's why just because you're at the euphoria stage or even the exuberance stage, it doesn't mean that things are going to change tomorrow unless there is an event that changes the entire dynamic, right? All of a sudden, we forced Goldman Sachs into bankruptcy literally overnight, that type of thing. That would cause this massive sea change in expectations. But markets are about expectations, and expectations are very positive right now. And it's very hard to slow that momentum all at once unless you have some type of event occur.
Okay. All right. Well, we got to start wrapping it up here, Lance. So trades, what trades, if any, have you guys made since last week? Probably none. It's been the holidays, right? You've been on vacation with your family, more or less.
No, it's been there's as we kind of talked about before, there was really no reason to trade much over the holiday. Nobody's been around, right? So all the market action you've seen over the last kind of week or so is really more inmates running the asylum, and so that's kind of always a dangerous market to trade into. Monday, all the traders will come back to the market. Monday will be the first real week we've had in the last couple that haven't been punctuated by holidays and light trading volume, those type of things. So really, next week will give us a good barometer on whether or not this market can find some footing or not.
Okay. All right, Lance. Well, look, Happy New Year to you, your family, everybody there at RIA. Super excited to see you in Houston in just 2 weeks from now. Folks, if you think one of the absolute best New Year's resolutions you can make on this program, besides going and seeing Lance and I live in Houston, is to just see Lance on this program week after week, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Look, 2025 could be an interesting year. Lots of potential for disappointment, but as Lance was saying, it should be volatile, probably going to have lots of ups and downs in it. If you'd like some help in navigating that, highly recommend that those watching this channel who would like such help get it from a good professional financial advisor. If you don't already have a good one who's helping you navigate that, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week after week. Perhaps even Lance and his team there at RIA. You'd like to hear their opinion on your personal situation. To do that, just fill out the short form at thoughtfulmoney.com, and the firms will be in touch with you very shortly after that. When you're over there at thoughtfulmoney.com, don't forget to hit the newsletter link at the top of the page. Sign up for our free Substack. Lance, as usual, give you the last word.
Yeah, and don't forget that January the 10th is known as Quitter's Day because that's when everybody quits their New Year's resolutions. So if this is your New Year's resolution, don't quit on the 10th. Just keep going. It'll be good.
Don't be a quitter. That's if we'd had more time, I was going to go through kind of a success practices for sticking with your resolutions. Maybe folks, if we get time next week, that can be next week's rant. But anyways, well said, Lance. Folks, make sure you set yourself up to not fail on your resolutions. And of course, the one to watch Lance every week is a pretty easy one to keep. So don't be a quitter. Buddy, I'll see you. Well, I'll see you here next week, and I'll see you in Houston 2 weeks from there. Take care, buddy.
See you then.
All right, everyone else, thanks so much for watching.